Welcome to CFP Exam Prep. Today we're diving deep into monetary policy tools, specifically focusing on how the Federal Reserve implements these crucial instruments to manage the money supply and economic stability. Let's break down the four main monetary policy tools. The Federal Reserve primarily uses reserve requirements, discount rates, open market operations, and interest on excess reserves to influence banking behavior and the broader economy. Reserve requirements are the percentage of deposits that banks must hold in reserve. When the Fed increases reserve requirements, banks can lend less money, effectively reducing the money supply. One critical point often missed on the exam is that lowering reserve requirements has the opposite effect, allowing banks to lend more and expand the money supply. During the 2020 financial crisis, the Fed actually reduced reserve requirements to 0%, a historic move that many test takers don't realize. The discount rate is the interest rate the Fed charges commercial banks for short-term loans. A common mistake students make is confusing the discount rate with the federal funds rate. The discount rate is typically higher than the federal funds rate because the Fed wants banks to borrow from each other before coming to the discount window. For example, if the federal funds rate is 3%, the discount rate might be set at 3.5%. Open market operations are perhaps the most actively used tool. The Fed buys and sells government securities to adjust the money supply. When the Fed buys securities, it increases the money supply by injecting cash into the banking system. A frequent exam trap involves questions about the direction of these transactions. Remember this key point. Buying securities equals expansionary policy, while selling securities equals contractionary policy. Interest on excess reserves, or IOER, is a relatively newer tool introduced after the 2008 financial crisis. The Fed pays banks interest on reserves held beyond the required amount. Students often overlook the significance of this tool. When the Fed increases the IOER rate, banks are more likely to hold on to excess reserves rather than lend them out, effectively reducing the money supply. Here's a practical example that often appears on the exam. If the economy is showing signs of inflation, the Fed might implement a contractionary policy by increasing the discount rate, selling government securities through open market operations, and raising the IOR rate. All these actions work together to reduce the money supply and cool down the economy. A critical concept that students frequently misunderstand is the timing and effectiveness of these tools. Open market operations have the most immediate effect, while changes in reserve requirements take longer to impact the economy. The exam might present scenarios where you need to recommend the most appropriate tool based on the urgency of the economic situation. When studying for the CFP exam, focus on understanding how these tools work together rather than memorizing them in isolation. Questions often present complex scenarios where multiple tools are being used simultaneously. Pay special attention to the direction of the policy, whether it's expansionary or contractionary, and match the appropriate tools accordingly. Remember that the Fed's primary goals are price stability and maximum employment. Every monetary policy decision relates back to these objectives. Understanding this fundamental relationship will help you navigate through even the most challenging exam questions about monetary policy tools. Keep practicing with scenario-based questions and always think through the chain of cause and effect when analyzing monetary policy decisions. This approach will serve you well on exam day.